I've been thinking a lot about is just a major regime shift happening in monetary policy and how it's conducted.
We all know the mandates are shifting. It's not a dual mandate. It's finance the government.
I generally agree with the premise of like capital flowing away from the US and into other places. There's a lot of ramifications about that, and most of them are not good for like equity multiples.
So you've talked about for a lot of years of like capital to labor. It feels like so much of the direction is headed towards higher tax rates, especially for high income earners and the rich.
There's a socialist Democrat primary candidate in New York. Like, that's the effect of a generation of ignoring labor.
All I can think about is we let him have too many beers before this.
Nothing said on Forward Guidance is a recommendation to buy or sell any investments or products. This podcast is for informational purposes only, and the views expressed by anyone on the show are solely their opinions, not financial advice, or necessarily the views of Blockworks. Our hosts, guests, and the Blockworks team may hold positions in the company's funds or projects discussed.
All right, so next up here, we have the Forward Guidance live roundup. So I'm emceeing, but also the host, doing double duty here today. But yeah, super excited to be here. Anybody here listen to the Forward Guidance podcast before? Yo! What's up? That's sick. All right. Well, you'll see we finally managed to wrangle Tyler out of dad life. He's actually here in person for the first time for a live roundup of Forward Guidance in the house. What's going on, Tyler?
Nothing much. Can you hear me? All right.
Yeah.
The one thing that I wanted to say was I talk a lot of shit to Felix and roast him for being a CFA charter holder. And I walk in and he's like 6'5" and built like a lumberjack. And I'm like, God damn.
Yeah, you're real quiet now about that. Glenn, what's going on?
I'm just happy to be here. Grateful for the opportunity to be surrounded by such nice guys.
But yeah, nice tall guys. That's the prerequisite to be on Forward Guidance. All right, well, let's get into the swing of things here. Lots going on in macro, as always. It's been a tough few weeks, unless you think that you can pretend to be a geopolitical expert, which I am not. So I've mostly just been kind of sitting on the sidelines and you know, making memes about it when I can, and seems like it's been mostly resolved. So we're back to the macro fundamentals and trying to just understand where markets are going from here on out. So yeah, why don't we just start off the top? Would love to get both of your views on just what's your high-level macro framework right now, where do you think we're at, and how are you guys thinking about things? Tyler, do the honor.
All right, so I read a lot of Pippa Malmgren. She absolutely nails this, and I think everything that's happening in the media has been completely pre-discussed beforehand. And her read is essentially like everything that's going on with Iran has been agreed upon behind closed doors, and we're giving up pieces of Taiwan to China. We're giving up, you know, certain autonomy with Iran and Israel. And all these things are pre-negotiated behind closed doors before they actually happen, which is why, you know, geopolitics have been a sell the news situation for a while. And she believes we're in a global peace dividend here, which, you know, as time goes on, it feels like that's the true reality. And everyone loves to, you know, get on mainstream media and talk about World War III. But her argument was, we've been in World War III for the past like 5 years and no one even realized it. So I'm kind of in that camp where, you know, sell the news and oil, and, you know, we're probably heading into some first turning. You know, the neocon playbook, and I put this on my Twitter, it's been like, you know, go into another country and, you know, disrupt it and regime change, and, you know, we get resources or labor out of it. And now it could be completely different. Like look at the market cap of Palantir now. It's freaking like $350 billion. They can predict the future. They have AI before everyone else. So their strategic strikes are like you know, we could be in a world where like it's not forever wars anymore. This is a new framework of multipolarity, or whatever you want to call it, that no one's realizing. But we're putting a staple of, you know, the last 40 years of you know, military-industrial complex war on what we think that is, but there could be a whole new system at bay, and it follows into that whole first turning, fourth turning framework where we're moving out of the fourth turning and going into the first turning here. So that's where I'm kind of at geopolitically. Is that a long enough answer?
Yeah. Thanks. Our resident geopolitical expert.
I like how I just made fun of people who are trying to predict geopolitics, and then you're just like, here's my geopolitical framework.
Sorry. Well, honestly, I've never seen, no one does it consistently, but Pippa Malmgren does it consistently. No one gives her credit. It's just like, if there's one thing you should do is get a subscription to her Substack. It's incredible. Her dad was like advising, the last 5 presidents, and there's like a generational knowledge there that no one realizes, and I don't know why more people don't like follow that religiously.
Do you have a ref link for that?
Yeah.
For how hard you're chilling?
I have a referral. I'm getting paid for.
All I can think about is we let him have too many beers before this. Guy gets out of the house one time.
Want to earn real yield on your Bitcoin without leaving the ecosystem? Echo Protocol is the first Bitcoin liquid restaking and yield layer built on MoveVM. It powers the BTC-Fi economy on Aptos, securing nearly half of all bridged assets on the network and minting over $200 million in ABTC. With Echo, you can easily acquire, hold, and earn on Bitcoin via ABTC, their yield-bearing Bitcoin asset. Echo already makes up around 70% of Bitcoin supply on Aptos, and it's just getting started. Learn more at echoprotocol.xyz. As always, investments in blockchain technology involve risk, terms and conditions apply. Do your own research.
All right, Quinn, where are you at?
So I think actually the biggest story in markets right now is this push-pull between a decelerating economic growth picture and how effective Trump will be at manipulating or coercing or whatever you want to call it, the Federal Reserve action. I think this recent bout of strength in the market is due to last week we had a very hawkish Powell, like resoundingly hawkish SCP and rate forecast projections. We saw unemployment rate expectations go down, or up, worsened. Inflation up, worsened. And yet they actually turned into an even more hawkish rate cut stance. So those facts together are very not good for the market, like in normal times. And I think we saw this over the weekend. The Iran thing, I do also agree, was a big fade because Trump spent the first 3-4 months of his presidency on a sole mission, doing anything, signing any deal to get the price of oil down. So he wasn't going to do anything geopolitically that reversed all of that effort. But what happened after the Fed meeting was the two formerly most hawkish or very hawkish governors, Waller and Bowman, who on the surface it sounds crazy because these two formerly hawkish people came out and said they support July cuts. But in reality, it's not that surprising because they're the two people that Trump appointed in his previous term who have the best odds of becoming the next FOMC chair. So for me, if the Fed does take preemptive action, if you've noticed in Trump's tweets, notice his latest ones now go after the board, the FOMC board, not just Powell anymore. He's basically trying to instigate, more. It's not working on Powell. Get everybody else to kind of rally behind to take action. And ultimately, the market's only pricing in 20% for July, so clearly people don't really believe it thus far. But I do think that for asset prices where NASDAQ, S&P 500 multiples sit at all-time high-esque valuations, where there's not much room besides earnings growth, it's basically this lever of liquidity that the market is debating whether or not it's going to be in July, is it going to be in September, is it going to be after Powell's done in June of next year? So for me, that's the biggest thing, I think, in markets that maybe people are talking about it, but I think it's very important. Ultimately, I think that at some point in the second half, when a lot of these economic forces do start to weigh more heavily on the economy, I think there's going to be a more meaningful deceleration in the growth picture, and that might have negative implications if unemployment rate goes up. The passive flows maybe slow down into what's keeping equities so elevated. So I don't think it's as sanguine of a risk-taking environment as most people believe. And you also have, on the other side of the big, beautiful bill passing, a very large supply of treasuries to refill the TGA, which should put upward pressure on yields. So
I'm going to take the opposite side of that. Because I just think like buybacks are going to keep going no matter what.
we're in the blackout, no?
Well, yeah, you might get a brief like hiccup, but over the next 6 months, there's no stopping that. It's $1.4 trillion getting taken out of the market every year. And, as soon as I've been at like 5 hedge funds, and the long short hedge fund community is just a bunch of morons because all they do is chase when volatility goes up, they buy downside protection, and then it's like this self-reinforcing like price is the news thing when you should be selling volatility when it's the VIX is inverted. And it's a whole problem with the long short community. But those little brief snippets generally correlate with when the buyback blackout period comes, and then buybacks just slowly shrink the floats of all the stocks, and they just keep going up. That's just not going to change. And not only that, but it's getting more sensitive. Where like Mike Green had a great call where he says like every dollar that goes in the S&P, it used to be a 1-for-1 thing, where a dollar goes in, it causes a dollar rise in the S&P. Now when a dollar goes into the FANG stocks, it causes like a 20x multiple of sensitivity to the rise of the stock price. So you're like, those are all the things that just aren't going to change until you get a credit event. It's just we're watching a giant debt for equity swap before our eyes into these dumb passive products that have been co-opted the entire 401k system. And am I ranting enough yet? Do you want to hear what I really think? So that's why I'll take the opposite side.
I think this dynamic, this contrast is like the ultimate thing to figure out in markets today. And I'm glad he brought up Mike Green because it's interesting. He's kind of diagnosed like both sides of this because he's been in the camp, like he's been calling for a recession for a long time now and talking about this like economic weakness underneath the surface. But then he's also on the side of looking at like the passive thesis and, flows and buybacks. And yeah, it just feels like there's this ultimate tension between the two these days. And it's really hard to figure out because so much of like markets has been effectively socialized in many ways. But at the same time, you see beneath the surface just so much like fragility. I mean, you look at the labor market, it's so much weaker than what the top line level data is. And that's what's so perplexing, right? Like you look at the way Powell talks at Fed meetings where they only really talk about the unemployment rate. But if you go look at some folks that are really deep on the labor market data, it's a lot weaker. But at the same time, you just have these endless like flows machines coming and forth every single day.
Yeah, so like I actually agree with everything Quinn said in terms of the economic data and growth slowing. I just have if you do get forward indicators saying you're going to cut rates more, the market's going up. Like there's no doubt about that. That's just going to fuel the debt buyback boom. And then, the kicker is you got to watch credit spreads. And the high yield market's breaking out to new highs here, and credit spreads are falling, which is causing more and more, money. When you get credit spreads low, it just goes out to the frontiers even more, which is why I pump Rocket Labs every single frickin' week on this podcast. But it's also Rocket Labs might as well be crypto, and because the credit spreads just keep dropping. And what's happening is there's a dearth of high yield, so all the high yield bond managers are reinvesting all the dividends right back into high yield, and that's why it's creating this self-reinforcing cost of capital drop in credit markets.
I think that's the crux is that it can be binary and like these two different outcomes that are very different because the system, like when you have valuations of every asset at all-time highs, the whole like the market can stay irrational longer than people can stay solvent thing is just simply a liquidity thing. So that's true. They both can be true where, okay, if that's kind of why my point is around the Fed, if they do start to take more preemptive action, Powell's point is, well, unemployment rate's at record lows, 4.2, like why do we need to be in any rush? But then you have this increasingly probably growing pressure and obviously for the reason of keeping markets elevated from the administration. If you get that, that is a recipe. Preemptive liquidity injections is a recipe for 2000 type blow off like moves for sure.
100%.
But
that's what it
comes down to if that is going to happen.
Yeah,
and I don't think it's clear. And what my point is, if the market is still only pricing 20% for a July cut, and I'm of the belief that waiting till September is not great for assets.
I think that whole dynamic that you diagnosed around, it feels something I've been thinking a lot about, is just a major regime shift happening in monetary policy and how it's conducted. And the current FOMC's pretty much the situation at hand of why they're not cutting is it feels like they're dragging their feet towards what they see is the inevitability, which is the reintegration of monetary policy and fiscal policy, i.e. fiscal dominance. So the last time we had this was before basically the Treasury Accords in, I think, like 1954, where before that, the Treasury and the Fed were working hand in glove. They were operating, basically coming out of World War II. They were doing yield curve control and like overt yield curve control, not like soft yield curve control like we've seen the last few years. It was like we're capping rates there, like BOJ style. And that was really where, for me, fiscal dominance is monetary policy is there to manage the interest expense effectively of the federal government and funding and monetizing it. And so you see this dynamic start to come forth now where you can see the Trump administration and Scott Bessent and everybody is really moving the needle towards this idea. You can see when they're harping about rate cuts, they're not really talking that much about inflation or the labor market or economic weakness. They're talking about let's cut rates because it's going to bring down the interest expense level. If we cut 200 bips, that's the quickest way that we can lower the fiscal deficit. So we can see where we're going. And it's just we're in this interesting moment where, we're starting to see these headlines about Trump interviewing who's going to be the next FOMC chair. We all know what's going to happen in March 2026. There's going to be a stooge put up who's just going to jack rates to 200 bips, regardless of where the economy is. But in the meantime, we're in this weird moment where we're just kind of seeing them drag their heels, and it's this major regime shift right now.
Yeah. And are you going to sell the market before that? Before the stooge? Like, how long do you wait to buy it when the stooge gets Powell? It? You what?
Do you think he can or will replace Powell before his term's up?
I don't know. That's a great question. I think they're going to start discounting it way in advance because we all know the mandates are shifting. It's not a dual mandate. It's finance the government. After 2008, the government put the private sector on its balance sheet, right? That's essentially what happened. And now the government's in terrible financial condition, and every country, this is what's normal about history is this happens to every country. Yet we don't think like the politics matter. Like this is an emerging market. This is normal in emerging markets. If you watch them, they just go up their currency and then they change the goalposts. So the dual mandate, the mandate is now, I said this, is like lower interest rate expense and keep nominal growth higher than debt growth. And it's why this industry exists is because the mandates have shifted. And it's like really hard for people to understand. The other thing I was going to say is like home ownership is at the worst affordability for like a generation, and people aren't having kids. This is a national emergency. Like it is, and no one's talking about it. And it's incredible to me that the gap in wealth is not a bigger issue. Probably because boomers own all the mainstream media companies and they're not listening to Forward Guidance. But I don't know. I think what's going to happen is like there's a socialist Democrat primary candidate in New York. Like that's the effect of a generation of ignoring labor. And what happens? That's the economy saying we're so centrally planned that like we've ignored labor for so long, and now it's shifting back. And the only way out of this is literally moving the mandates of the Fed and being just a financing. You're just going to finance super large fiscal deficits as far as the eye can see. And it's you better jump on the bandwagon of the frontiers because it's the only way you can grow out and then give wealth to the next generation so they actually start having kids. How many millennials here or Gen Zers own houses in New York City? Doink.
Not a single hand went up.
problem right
Boom.
there.
That is actually
That's why we're getting government run grocery stores in New York.
it is a massive signpost. I think that people like. It's easy to make fun of the situation, but like the financial capital maybe of the world and definitely of the U.S. elected in many cases you could argue this mayor would be the most powerful Democrat, like socialist in the country, because AOC and Bernie Sanders don't like really influence much policy in their seats. I mean, maybe Warren does, but that's like a massive signpost to me of what is very likely to come.
So I think the next point.
It's not good for asset prices.
Well,
Well,
okay.
it's polarizing. I think it's good for some asset prices, it's not good for others. Like Weimar
good for
Republic,
gold.
you're gonna if you get eaten up by like certain commodity inflation or labor inflation, you're screwed. But like if you're in Bitcoin as a store of value or you have some use case that stays ahead of that, like AI.
Okay, but what happens if the
cut me
stooge
off.
cuts 200 bips on the short end? The long end is going to sell off like mad. What's the mortgage rate tied to the long end? So we need to let's speculate here a little bit on what comes after that, because if you're trying to talk about unlocking housing affordability and you're like, okay, I'll cut the Fed funds by 200 bips, the 10-year is going to go to 6%. What happens then?
You know what you do?
You print the money?
No, if you're Bill Pulte, the Federal Home Administration, or FHFA, whatever the hell the acronym is, he's the head of the Federal Home Administration.
He just wants the Fed chair.
He created this new acronym called crypto as collateral, where they're going to create a massive boom in crypto so that it makes up the wealth gap from boomers, so you can use your crypto to borrow against it and buy homes. Like that's what's going to happen. I mean, name me what else is going to happen? I mean, maybe it's an AI boom, but like, this is the way for labor to catch up in the wealth gap, is my macro read.
What happens is, and we're already seeing it with the dollar, is like probably the most lifeless. The strongest chart in the whole market right now, in my opinion, is the 2s10s yield curve. Like, it does not dip at all. Gold is close, but the steepener is probably the strongest chart I see when I look through every asset class and ratio. And housing is horrific because, yeah, you're steeping the curve in that case. But the dollar is like maybe the most lifeless chart, where you have like geopolitical conflict, a 20% rise in oil prices. How many people in this room know that the U.S. is the largest oil producer in the world? Like, most people forget about that. And so all of these things should be super dollar bullish, and the dollar can't get off the ground. And so we're living in this world. Felix and I were in D.C. last week. We gave a presentation on kind of the ramifications of some of these, which did talk about.
You guys
weren't
are
invited,
so
you wouldn't
important.
understand.
You're so important.
It's way too professional of an event.
If you didn't ditch us, you could have been invited, but that happened while you're on hiatus.
Yeah, you couldn't wear chubby shirts with a little beer spill.
You're not supposed to roast me in person.
Stays on the keyboards.
Yeah.
Let's talk about BTC Fi and why Echo Protocol is critical to it. Echo is the second largest protocol by TVL on Aptos. It secures nearly half of the bridged Bitcoin on the network, with $200 million plus in ABTC already minted. So what does Echo do? It lets users restake Bitcoin, earn yield, and participate in BTC Fi apps on Aptos, all without giving up control of their core Bitcoin exposure. With just a few clicks, you can mint ABTC and start earning yield, backed by the most dominant Bitcoin layer in the Aptos ecosystem. If you're looking to put your Bitcoin to work in a secure, high-growth environment, Echo Protocol is where BTC Fi begins. Learn more and start earning at echoprotocol.xyz. As always, investments in blockchain technology involve risk, terms, and conditions apply. Do your own research.
But so you have the dollar, which would be the thing most impacted by that. And so what's happened in the last, if you pull up a chart of U.S. equity outperformance relative to rest of world equities against the dollar, it's 1-to-1 correlated on a big picture time frame. And so we've had multiple peaks, like in the 70s and then 2000 and now, where U.S. assets relative to the rest of the world is a major high, and the dollar is also at a very large high relative to assets. And the reason they're so correlated is because you need dollars to chase the highest performing asset in the world. But when things are going up, it's very hunky-dory, and we just assume it's all good. But when that trend reverses and all of a sudden people don't want U.S. assets, don't need as many dollars, like we've been importing deflation for 20 years because of the strong dollar. Every year the dollar goes up 5% versus the rest of the world. You know, right off the bat, our costs from an importing perspective, which we're the largest consumption nation in the history of mankind, go down 5% if the dollar's up 5%. When that reverses, no one in the investing world today has really been around for a world where the dollar's depreciating 5% every year, and your inflation, you know, tailwind from the starting point is so high. So there's a lot of ramifications about that, and most of them are not good for like equity multiples. They're good for other assets, though.
I agree with that. And I guess like Meltem Demir's had this point in one of the other sessions where she's like, if you take into account like the dilution of the currency and then the currency falling, you're basically at like a 10% hurdle rate just to stay flat in terms of like, you know, making money. And so where the hell do you put your money if it's not making 10%? Like you're losing, and that's probably the real math of like investment in general. And that's at an increasing rate. If the dollar is selling off more and more, like where the hell do you go? And maybe it's repatriation of back into emerging markets. That's probably a large
Emerging markets, Europe.
Yeah.
I feel like it was a very high conviction view in the lows of April to buy rest of the world, and even January as well. It was a clear bet. Like, if we're going to go into this world of major US dollar depreciation, I want to be short US assets and long the rest of the world. It's going to be fantastic for them. But this is always what's hard as traders, is that you have to think about where we're at now, right? Like the euro is just been an absolute tear. All these other assets. Yeah, it's a tough one. I'm curious how you both think about that, especially you, Quinn, because I feel like fundamentally you agree with that premise, but then you look at the tourists, right? It's just like, it feels like everybody, I mean, I was in Europe, out of Europe right now, but it just like, it feels like this distinction between the fundamentals versus the froth, and, you know, all the fast money went in, but like you know, we've talked before, like I've had Shrub on the podcast, and he has this view of the Klauses of the world that are super long Mag 7 on an unhedged basis because they thought the US dollar would never go down again. All that big institutional money takes a really long time to move, especially in Europe because they only work 10 hours a week. So it takes a long time for that to transition over. What's your read on that?
Yeah, it's repriced for sure. And I think global equities, in many cases, aside from like case-by-case basis, have all repriced quite significantly. So, I mean, that's, I guess, the nice thing about being a macro investor is that there's alternatives where if you're looking at the equity market and it's not super attractive, you don't have to take action. You can get 4% in cash, you can buy gold, you can do all these other things. And I think that initial flow, like, I believe in a secularly weak dollar environment over the next multiple years. So I generally agree with the premise of like capital flowing away from the US and into other places, so that aligns. But whether or not other developed markets is the best choice for that is probably where I would, if you're gonna go outside the US, you might as well probably just go to like Latin America or something, because they're cheaper, probably better demographics, better growth characteristics, probably more of their economy is inflation protectant versus from commodity production. And so I think the risk reward there might be better. But Europe still has, I mean, we have July 9th trade deals, got to get through. There's like worse demographics and in many cases debt problems than the US. Playing fiat to fiat pairs is tough because I just view them all as going to zero, and it's like once a year where I have a really strong like dollar yen, dollar euro type of view, because otherwise it's just like you're just gambling on timing of like who's going to run into a big problem first before they all intervene together.
In terms of like how capital constrained, like we saw more like as a 20-year cycle coming out of Europe into the US. So like this was probably a short squeeze on European markets, which is usually the start. You know, the old John Templeton, like bull markets are born on pessimism, rise on skepticism. mature on optimism and die on euphoria. They're probably like the first.
Is that why you got to read that?
No, that I didn't read that. This is actually better. I guess. But check this out. So I don't think money is going to completely come out of the U.S. though, because we're the innovation, capital of the world. But this is wild. This is from this Arizona State professor named Bessembinder. I don't know if anyone's read this, but it's deep in the weeds. So after looking at over 60,000 public equities globally over 20 years, 2.39% made up all of the wealth creation. So like, which is just wild to think about over like a 20, 30-year span. Most companies just destroy capital, and then it's like a Pareto principle, like very few amount actually return money. So like, I'm probably gonna roast this conference a little bit, but like most people here are full of shit probably, and very. But then a few of them are gonna come out and they're gonna be being a billionaire. This is just really hard to tell who's gonna be the ones. But like, it's I'm an honest person here. It's just an honest broker. But
Just an honest trader.
Yeah, but everyone, you got to try to. Hey, I respect the man in the arena. Like Quinn loves, being the man in the arena, where you gotta try to create things. And I have admiration for that as someone who spent a time risk adjusting returns in the hedge fund industry for 15 years and wasting my life. So.
Noted.
But yeah, you should read that Bessembinder paper because it's like really fascinating when you think about how much effort goes into valuing companies and only 2.3% actually like really return wealth, and then think about what themes you want to play and try and find the best actual companies in that theme, because I think that's the way to really stay ahead of the fiscal dominance play for the next 10, 15 years. Is just like, I think people in this room understand that crypto is going to be one of them, and you just got to find the right entrepreneurs to back. And it's still massively early. And then AI infrastructure in space, and
Tyler will tell you that only 2% of companies in the world ever create wealth, and then he'll also tell you to go buy a scam Bitcoin treasury company that did 100 million pipe into a $1 million market cap.
Oh, come on. MicroStrategy, we nailed that one.
We're talking about the 20 other ones that just got spun up in the last 2 weeks.
I was talking about MicroStrategy when he issued that first bond. It's on record.
You did, yeah.
Yeah.
You know what people don't talk about as much these days is the whole currency accord thing and the possible agreements there, probably because we've all been caught up in geopolitical stuff. But yeah, it feels like, tariffs are going to come back into the mainstream narrative and discussions again, I feel like pretty soon, especially with the July 9th deadline there. And the more I look at it, a devaluation of the dollar by 15, 20% solves a lot of problems. But obviously you pair that with, Tyler, you brought up many times the Asian currencies and just the secular intentional weakness that's been associated on that side for so many years. And I'm curious where you both are at in terms of the likelihood of that occurring, because it doesn't feel like it gets talked about that much these days. But, we had a few of those moments a couple months ago where we had the Taiwanese dollar saw a huge move, mostly driven by insurers that I think we're front running some of this potential move, but it's been a bit quiet lately. I'm not sure what you guys think.
Yeah, I think Taiwan was first because of the obvious behind-the-scenes security agreements that were probably discussed. And so they felt it to be prudent to act in a way that the administration over here wanted them to. But I do think it's a signpost for what's to come, because if you just take them at their word, which has been, like, aside from Taco at the top, like the other guys have been kind of speaking what they actually believe, like Moran and Besson, et cetera, Lutnick. So I do think stuff like that is ultimately in the works, whether it be through, in the case of Taiwan, maybe the central bank no longer supporting their own currency, but some sort of devaluation. The thing in the near term, though, these things take so long to play out. There's another, hard to believe, but we still are only 6 months into this administration. So I think in the near term, I don't know how likely, because positioning is super short dollar. So if you're a central bank or government trying to play with currencies and weaken the dollar or strengthen your own to get the most bang for your buck, you're not doing it when there's record historical short dollar, long yen type of positions in the market. And so maybe there's a rinse that's needed there, but ultimately probably what solves this requires a much weaker dollar at some point in the next 18 months.
What was the original question? I'm distracted by this clock counting down in front of me.
Well, currency accord, currency devaluation of the U.S. dollar, appreciation of the Asian currencies. You are the Asian currency master, CEO of the
Isla's
Vietnamese
favorite
dong.
currency.
Yeah.
What's your read?
What's your favorite currency?
I love the Chinese yuan. No, I just think we're probably in for a massive short squeeze in the dollar here for like, a month or two, just because when positioning gets this stretched, you're going to get, a comment somewhere that causes, or it might even be like a tax holiday, or Trump can, and this is where we're in the world of central planners and centrally controlled economies, where like Trump will say, oh, if you invest $1 billion, you get, 0 taxes for the next 10 years. Like that'll cause the dollar to go up. There's so many things you can do to manipulate the system and capital flows that I think we're at this point where you'll do anything to retain your monopoly of global capital. And I don't think he's just gonna go out and the dollar's just gonna plummet secularly here. It's gonna take a generation, but over time, the weaker dollar will allow us to reindustrialize and create manufacturing again. What's kind of wild to think about is like, I don't know what the hell these buildings were before, but like there's probably
Definitely not a crypto conference.
Lots of manufacturing and, I don't know, whatever, textiles or whatever it was. And now there's like crypto conferences in them. The history of it must be wild. I'm going to Google that after. But so that's all I got.
That's a great point, Tyler. I just want to circle back. So part of this is also obviously the potential for tariffs and that whole thing. And one of the discussions at hand is about the pass-through, about who takes the hit. Is it going to be corporate profits or is it going to be passed on to consumers? And pairing that with like this theme that you've talked about for a lot of years of like capital to labor, pairing those two together, it feels like so much of the direction is headed towards higher tax rates, especially for high-income earners and the rich, and putting on tariffs and making sure it seems like Trump wants to make sure that they hit corporate profits and doesn't get passed on, or else you're going to get called at like Amazon or Walmart. So when I look at those dynamics, it keeps me a little concerned about U.S. equities, because it feels like one way or another, they're coming after those corporate profits. They want to make sure it doesn't get passed on to the consumer. How do you balance that with like this very valid view of AI innovation and technology being the best in the US, which is definitely true?
I would say, I saw this chart the other day, it was Microsoft employees over time, and it's now peaked. We saw peak Microsoft employees, and now it's dropping. And like one of the things that's just kind of wild and dystopian to think about is like, I don't know if you have friends that worked at Google or any of these companies, they don't do shit. A lot of them, they're your average employee, and they just sit there and these companies are behemoths. You could probably run them with a tenth of the, look what happened at Twitter. Like they fired 90% of the people. So like with AI, if it does a tenth of what it says it's going to do, you can run these giant oligarch companies with an ounce of the employees and still have you could probably way more. The reason why they don't fire people is because the social contract would break. It's probably the whole thing. And maybe I'm wrong about that, but I did see the chart of employees falling over in this AI era, and like, I listened to this one guy named Carl Schulman, who is an AI expert, and he was like, if you picture what AI does, is if we have capacity to learn about deep learning 4 hours a day, maybe 6 hours a day. And what AI does is it learns 24 hours a day, 365, and it compounds. And so like, imagine like when you hit that point of you're way more productive than any of us, what you can run a company on. And so, yeah, maybe taxes go up, but maybe productivity and innovation spike massively higher. And that, I think that's more true than not, because I think we're in a space race where you have to win the AI race, and they won't let a recession happen right now, because if China wins the AI race, they can take control of our whole system. So I think that's where we're at, where like, you know, any big, you know, rumbling of credit spreads widening or credit problems, they're just going to hand people money so that they can keep the AI thing going. So my long answer to
That's pretty valid. Yeah. What do you want to add anything to that?
Well, I think if you're a U.S. equity investor, you should be worried about tariffs, because like the one thing everybody can agree on is that a consumption tax raises prices. Like that's what's agreed upon, but what's not agreed upon is who pays the tax and what does the tax ultimately affect in terms of consumption trends or price trends. I think one way I think about it is if we know tariffs increase prices because they're tax, it's consumption tax, then either it gets passed on to the consumer and there's inflation, which isn't great, or the corporate has to eat the increased costs and not pass it along to the price, but then their margins get hit, which also isn't great. So I think that's what the market is trying to suss out right now. And to me, it's becoming clear, and I think it will become clear, that in the near term, it is more of a growth hit. Consumer confidence, business confidence, hiring's down, spending's down, aside from the front running. And so I tend to side in the camp that it is more of a near-term growth hit than it is that masks the inflation shock, so cyclical downward pressure on growth. But ultimately, if you have to rejigger supply chains and nearshore, friendshore, that is long-term inflationary. But earnings season is like 3 weeks away, and that's going to be something big to watch in terms of how that's affecting both Q2, the first full tariffs, and then guidance going forward.
Well said, guys.
One last quick thought was,
You got 25 seconds.
yeah, the market's at all-time highs, and everyone's bearish. So, you know, it just...
That's fair.
But here's the other thing is, it's not... The market's at all-time highs, but the social contract is breaking. And that's why you got a socialist, you know, guy in New York City. And so I'm not saying this is great for everyone. It's just that the policies are just for making the market go higher. It's a centralization thing.
Yeah, fully agreed. All right, that's all the time we got. Thanks for finally doing this in person, guys. That was a lot of fun. Hope you all enjoyed.
Thanks.
Yeah.